Have you ever been scrolling through social media and seen people saying things like, buy the dip, or I just bought Tesla stock, and you thought, what are they actually buying? Today, we're going to break down stocks in the simplest way possible, what they are, how they work, and why millions of people invest in them. What exactly is a stock? A stock represents ownership in a company. When you buy a stock, you're not just buying a number on a screen. You're actually buying a small piece of that business. Let's imagine something simple. Think about a big chocolate cake. Now imagine that cake is sliced into thousands or even millions of pieces. Each slice represents a share of the company. If you buy one slice, you own a tiny part of the cake. If you buy more slices, your ownership grows. For example, imagine a company is divided into 10 total shares, and you own 5 shares. That means you actually own 50% of that company. Of course, in real life, large companies have millions or even billions of shares, so investors usually own a very small percentage. But the idea stays the same.
Why do companies sell stocks? You might be wondering, why would a company sell pieces of itself to strangers? The main reason is simple: to raise money. Starting and growing a business costs a lot of money. Companies may need funds to build new factories, create new products, expand to other countries, hire more employees. Instead of borrowing money from banks and paying interest, companies can sell shares of their business. The money they receive from selling shares doesn't have to be paid back.
A simple example. Let's say a person named Maya wants to open a sneaker store called Fresh Kicks. She calculated that she needs $100,000 to start the business, but she only has $50,000. So she decides to divide her company into 10 shares. Since Maya invested $50,000 herself, she keeps 5 shares. Each share is worth $10,000. She sells the remaining shares to investors who believe her business will succeed. One sneaker enthusiast named Jordan buys 1 share for $10,000, giving him 10% ownership of Fresh Kicks. With help from other investors, Maya raises the full $100,000 and opens the store. How investors make money. Fast forward 5 years later, Fresh Kicks becomes extremely successful and opens several new locations. The company that was once worth $100,000 is now valued at $300,000. Jordan's 10% share is now worth $30,000. Since he originally invested $10,000, he could sell his share and make a $20,000 profit. But investing doesn't always go perfectly. If the business struggled and its value dropped to $80,000, Jordan's share would only be worth $8,000. That means he would lose $2,000. This is exactly how the stock market works, just on a much bigger scale. Some companies also reward investors with dividends, which are regular payments from the company's profits. Where do people buy stocks? Stocks are bought and sold on something called a stock exchange. You can think of it as a marketplace for company shares. 2 of the most famous exchanges are the New York Stock Exchange, NYSE, and NASDAQ. Today, you don't need to go anywhere physically. You can buy stocks easily through investment apps on your phone. When a company becomes large enough, it may decide to go public, meaning its shares become available for anyone to buy. The 2 main types of stocks. Most companies offer 2 major types of stock. Common stock, this is the type most investors buy. When you own common stock, you usually get voting rights in company decisions, the chance to receive dividends, and the potential for strong growth. However, it also carries more risk. If the company fails, common shareholders are last in line to receive money. Preferred stock works a little differently. Investors usually don't get voting rights, but they receive other benefits. The biggest advantage is more reliable dividends. Preferred shareholders also get paid before common shareholders if the company runs into financial trouble. Because of this, preferred stock is usually considered less risky, but it often grows more slowly. Why do people invest in stocks? One big reason is potential returns. Bank savings accounts may give around 1 to 2% interest per year, but historically, the stock market has returned around 7 to 10% annually over the long term. Of course, higher returns come with higher risk. Stock prices can move up and down quickly. Some investors hold stocks for many years. Others try to make money by trading more frequently. Final thoughts. At the end of the day, stocks represent ownership in real businesses. When you buy a stock, you're becoming a small owner of that company. If the business grows and succeeds, your investment may grow too. But smart investors remember one important rule: never put all your money into a single stock. Diversifying your investments helps reduce risk. If you enjoyed this explanation and want more simple guides about money and investing, make sure to like the video and subscribe. And let me know in the comments, what financial topic should we explain next?